Let's take a look at a balance sheet. And the balance sheet can sometimes seem confusing, but really the thing is more about logic than anything else. And here's the overall idea. What do you own and how did you get it? The balance sheet shows what the company owns in terms of assets and how the company got those assets. Assets are paid for by credit extended to you by either suppliers or lenders, those are liabilities, or by the owners of the business, which is stockholders' equity. So assets have to equal liabilities plus owner's equity. And the balance sheet shows where the company is at a specific point in time, the financial position of a company on the date noted. It doesn't, though, show you how the company got to that position or where it might be headed into the future. It's just a snapshot. Let's take a look at a sample balance sheet. Again, assets are what the company owns. They're divided into current assets, which are generally defined as assets that are expected to be converted to cash within a year. Things like, well, cash itself, receivables that you expect to collect within a year, inventory that you expect to sell within a year, and then longer term assets like plant and equipment and tools that you might use as you build products. And remember that the cash flow statement, as I mentioned before, is really just a little more information about how you got to that cash line item amount on the balance sheet. And assets are balanced by, and they have to be equal to, liabilities plus equity. So if we go over to liabilities, accounts payable are bills that the company has to pay generally within a year. Short-term debt is also debt that's due within a year. So those would be called current liabilities. Long-term debt is a long-term liability, and if you add that together with your current liabilities, you've got total liabilities. And then you have equity, which is stock, money that shareholders have put into the company, and you have retained earnings, which is all the profit that shareholders have plowed back into the business versus taking out as a distribution or a dividend. So it's earnings that have been retained back in the company, so not distributed. And so just following logic, total assets, again, have to equal liabilities plus equity. But sometimes I think it helps to humanize the financial statements by sometimes thinking about your own finances. So as an example, what if you bought a house for $500,000? How would that fit into the balance sheet? Well, the house is an asset, and it sounds like a long-term asset. So boom, you got $500,000 in long-term assets. But how does that actually balance out? Let's say you've got a $400,000 mortgage that you took out to buy this house, right? And you used $100,000 of your own money when you bought it. So you got a $400,000 long-term liability in a mortgage and $100,000 in equity. And you add those two together and that equals the $500,000 asset of your house. So if you follow that kind of quick and simple example, you actually understand the balance sheet probably better than you thought you did. All the other details that come up are really just variations of that same logic. And yes, it can get complex, but the logic should be clear. So some questions you can answer by analyzing a balance sheet include things like, how much cash do we have to cover our short-term current liabilities? How quickly are our customers paying us? How much do our customers currently owe us, which is accounts receivable? How much product are we sitting on and we haven't sold yet? That's inventory. How much do we owe our suppliers? Accounts payable. How much debt do we have? That's short-term debt and long-term debt. And we could ask, how much money have the shareholders put into the business? That's stock, the money they put into the company, and also retained earnings.